great Indian consumer story, the FMCG sector, which is the fourth largest in the Indian economy with a potential market size of almost 7.5 lakh crores. In this, the products that you and I use daily, household, personal care and food and beverages account for nearly 70% of the industry. In the past, people's increasing purchasing power and increased availability of these products have been the key growth drivers. And these stocks have been D-Street darlings. If you take a look at it, over the last 10 years, we've seen stellar returns. And these stellar returns have actually come by over the last 2 to 3 decades itself. Even underperformers have risen 50% in the last 10 years. We have a handful of reasons for why these stocks have been D-Street darlings. The biggest one, of course, is the fact that there is a large addressable market. Buy what you can touch and feel, said Peter Lynch. Apart from that, there is relatively low capex versus other industries and negative working capital cycle, people getting money before they spend it. All of this obviously reduces the need for any further dilution and leads to higher return ratios, strong balance sheets. Less requirement for cash for daily needs also means that these companies have good regular dividend payouts, but above all these companies boast of extremely high quality, high pedigreed Indian as well as foreign promoters with great corporate governance and management history. Let's talk about the skyscrapers now. The ROE profile for stocks over the last 10 years. On an average, Hindustan Unilever has returned 83% in terms of return on equity. All the other stocks anywhere between 30 to 50%. Now let's talk about the key growth opportunities. The biggest one, of course, is the fact that major categories currently at a granular level still have just 2 to 3 leaders. So more leaders emerging would be a big opportunity. The second one, new growth categories, the likes of men's grooming, etc., would also lead to some growth. Bolt-on acquisitions, like I said, strong balance sheets. So can these companies go ahead and take on good companies and grow them? The likes of HUL acquiring Horlicks as well as Indulekha, ITC acquiring Savlon. It's believed that the next leg of growth for this sector will come from balance sheets, not just the income statement. And the big trigger is also increasing rural income, which currently accounts for just less than a third of the overall market. As rural income increases, demand increases, it could bring another field of opportunity for these companies. But like they say, no good thing comes at a cheap price. And the sector has been notorious for its high PE because over the last few years, we've seen all these stocks trade anywhere between 40 to 60 times. So to prevent oneself from the risk of entering these stocks at extremely high levels, experts usually suggest a systematic investment plan or buying on dips in these stocks. So SIPs and dips, that's the key for the FMCG sector.